Okay, international taxes. So tonight I have the probably the briefest slide deck of all the classes, but I guarantee you we will not get through it. International taxes is complicated, and what you can have on kind of one slide, we could sit and talk for 20 minutes about, as opposed to kind of the material in the past where you kind of blow through 60 or 90 slides in a class. So I actually shortened the deck from what it was last year, just to try to hit the core pieces. So tonight, I think the goal is really just to introduce you to the topic. You will not walk out of the room thinking, man, I can do a global provision, like look at me now, right? That's not how that's not the sensation you'll have at the end. But what I want you to realize is that when you're doing international provisions, there is an added degree of complexity to an extent, but not necessarily. It's not as daunting as some people think it is. So I'll try to explain some of the practical issues that I see in working through global provisions. Okay. So if you're doing a global provision, there's essentially 4 types of tax expense that you're trying to capture as part of your global provision. Okay, and these are listed on the right-hand side of the slide, and we're going to use this picture as our example of a global company that we would do a foreign provision for. Okay, so let's just talk about that picture first. Okay, so we have a U.S. parent, we have a U.S. corporation that sits on top. It does business in the U.S. dollar currency, and its tax rate's 38%. So that's a combination of federal and state taxes. The U.S. parent has a foreign subsidiary called Forco, which is doing business in country A, and it's in a box that doesn't have a circle in it, which means it's a corporation, right? It's a controlled foreign corporation. Its functional currency is the pound, and its tax rate is 28%. Okay, so that's a UK company probably. The tax rate in the UK has gone down, but I haven't changed the slides since last year. The second entity that USP owns is this FBR. So that's foreign branch, was what it's short for. So foreign branch is operating in a different country, country B, and that box has a circle in it because it's treated as an entity that's flowing through to the U.S. So that's a disregarded entity for U.S. tax purposes. Okay, so that entity is taxed both in country B and then also in the U.S. Okay. Its currency is the euro, and the tax rate is 34%. Okay, so right away, with that simple of a picture, you start thinking, oh man, you know, there's different currencies, there's different tax rates, there's different countries' rules. You know, you can see how this would get complicated fast, right? But the goal is, as we kind of attack the problem, is to break it down into pieces, right? Let's not try to like solve the world's problems like right away. Let's just look at one box first, figure out its provision. Look at the next box next, do that provision, right? Just like how I said earlier in class, when things get complicated with a provision, you got to break it down into small pieces. Okay? So we're going to do the same thing here. So the 4 components of the provision that are listed on the right, let's just kind of read through those, and then we're going to have supplemental slides for each. The first is what you guys already learned in the first 9 classes, which is USP's provision. Right? USP's got its own provision for its own operations. That's a just domestic company, really basic. The second is the non-U.S. taxes related to Forco and foreign branch. Right? So we got to go to Forco and do its provision. So Forco has perms, Forco has temps, Forco has a tax rate. It's just got a provision like the U.S. does. It just happens to be in a different currency with a different tax rate. And there's different rules that apply. But otherwise, the same provision mechanics apply because we're doing a U.S. GAAP provision. Okay? So think of that as the same as number 1. It's just playing by a different rule set with different facts. Right? But it's the same methodology that we would go through. Item 3 is the U.S. tax on the non-U.S. operations of foreign branch. So if foreign branch is subject to tax in 2 jurisdictions, we have to do a provision for foreign branch for country B purposes, but then we also have to flow foreign branch up to the U.S. and book a provision for the U.S. consequences of foreign branch as well. Right? So foreign branch is in 2 jurisdictions, that means it gets 2 provisions. Okay? In practice, you'll see foreign branch's U.S. provision essentially incorporated into USP's provision, but again, for the benefit of breaking this down into pieces, you might think of foreign branch as having its own incremental U.S. provision that's incremental to item number 2 on this list. And then the last thing is item number 4, U.S. tax on investments. Okay? So that's a little bit cryptic, but what that means is if USP owns Forco, and Forco's making money, something someday is going to happen. Either you're going to sell Forco at a gain, Forco's going to pay dividends, Forco will run out of business when it's got a pot of gold and it's got a lot of money. But USP is going to have profit or loss on its investment in Forco. Right? So just like if I went out and bought stock in a company, I would make profit or loss. That's the same thing for USP. So we need to think about what are the consequences to USP of owning Forco. Okay? And that's where this whole APB 23 unremitted earnings thing comes into play. Okay? So again, we're going to do this entity by entity, jurisdiction by jurisdiction. That is the key. Right? When I went out to Cleveland for Thanksgiving, when we landed, we went to a buddy's house for dinner, and he's a good friend of mine, and he's like one of the best provision guys out there. He lives in Cleveland. It's pathetic, right? But his company's provision, it includes 1,400 legal entities that they consolidate, and over 400 people actually touch his provision at year-end. And what that is he works at a large global conglomerate with operations all over the world, and the provision is very decentralized. Right? So if, Forco 1 is sitting in France and there's some controller guy over there that's going to do the provision, then Forco 2 is sitting in Italy and there's some controller guy there that's going to do the provision. And this guy's trained them all how to do it, and they all kind of do it instantly in a software package, and boom, it consolidates, but they all do their little piece. Right? And so, entity by entity, jurisdiction by jurisdiction. Okay? I mean, volume doesn't make it more complicated necessarily. It just makes it more difficult to manage. Okay. Questions on that? That's the overview. Okay. So, like I said, we're going to have kind of follow through slides on each of those 4 bullets. This first slide, again, this is the U.S. provision on USP. We've spent the first 9 classes on that. If you don't understand that yet, you're in trouble. Next slide. Non-U.S. tax for non-U.S. operations. Okay, so like I was saying before, this is where for Forco and for foreign branch, we're going to do the provisions for just those entities in just those jurisdictions. All right, so if we're going to do a Forco country A provision, we're going to figure out Forco A's payable, Forco A's deferreds. We'll do Forco's rate rec. We'll book their entries. We'll do it all kind of with integrity for Forco, where we're not combining it with another entity or the U.S. We're doing it specifically for Forco. Okay? And if you're Forco and your functional currency is the pound, when you keep your books and records, like if this company opened up Oracle, let's say that it uses an Oracle ERP system, it opens up Oracle and it looks for its income statement and balance sheet. So what currency do you see it in? Pounds, right? Functional currency. And if you call up the UK controller and you ask them about his or her income statement or balance sheet, they're going to respond with pounds, right? Because they think pounds. Functional currency means that's the currency you operate in. So that's the currency you're operating in. That's the currency you keep your books in. That's the currency that local accounting people are thinking about. So even though we're like the ugly Americans and we always think like American principles, which would mean dollars in this case, you have to make that kind of mental leap of, oh, this is a company that's using pounds as their functional currency. We need to think pounds, right? Everything is pounds. Okay, and therein lies, that kind of indirect comment, therein lies the vast majority of the difficulty in doing form provisions, right? If I'm sitting here in the U.S. and I think I need to do a provision for Forco, when I issue my 10K, what currency is my 10K in? Dollar, right? When I call the UK controller and I ask them about their financial statements, they're thinking pounds, right? So now we're already talking past each other. We're not even talking about the same thing anymore. This is not good, right? So, and you'll see one more disconnect on the next page. When you work on foreign provisions, the number one thing that you need to do is listen to the other person on the other side of the world and make sure that you're talking about the same thing. So sometimes the terminology you think is straightforward, it's not to the other side, right? I mean, sometimes terminology differences between languages are really significant. If you just sit here in the U.S. and you think dollars and just assume everyone's thinking dollars because dollars is what's in our 10K, everyone cares about dollars, right? But that's not right. Everyone doesn't care about dollars, right? And certainly if you were in a mainstream country like the UK, they might appreciate your dollar sensitivity. But if you're, you know, calling up Taiwan, I'm guessing Taiwan's not going to automatically revert to dollars. I'm pretty sure they're in their own world kind of thinking, you know, Taiwan dollars. So, so it's really important to think about what that other side is processing and make sure that when you're trying to explain what you're getting at as a U.S. GAAP provision person, that you're getting people on the same page. That, of all the time I've spent on foreign provisions, that communication disconnect, that is like 90% of the problems on foreign provisions, is communication. Okay, but in general, if we're doing foreclosed provision, foreign branch provision, it's just like our U.S. provisions we've learned in the first 9 classes. It's just different currency, different tax rates, different tax laws. Okay? So other than the currency that is an obvious disconnect, the second fairly obvious disconnect is GAAP versus stat differences. Okay, okay, so if I'm sitting there, let's say I'm a German controller for a big company, okay? And Quinn is sitting in the U.S. doing the U.S. provision for this consolidated group of companies, right? Like this company I just explained with this buddy of mine in Cleveland. So let's say that, so Quinn's sitting in the U.S. and she calls up me and she wants to understand my book tax differences, okay? So when she says book tax difference, what's she thinking, right? She's thinking the difference between GAAP and tax, right? Okay, and I intentionally said that a specific way. Because when I'm the German controller and I hear GAAP versus tax differences, I can understand that. Because in Germany, I file financial statements. I file statutory financial statements, which is required in a lot of countries around the world. And then I file a tax return, and there's differences between my financial statements and my tax return. Okay? So what is the problem inherent in that statement? What is the elephant in the room on that? Right, I just said GAAP, right? But again, if you're like the ugly American and you just kind of assume everything is U.S. GAAP, right? We're talking English, we're talking dollars, we're talking U.S. GAAP, right? It's like one way, it's our way. Okay, but if you're talking to the German controller, they're thinking German GAAP, right? I mean, I've been talking to a guy in Germany the last couple weeks on an issue all about trying to understand German GAAP. Because if you're the German controller, you file your financial statements either in IFRS or in German GAAP. Okay? German GAAP is different than U.S. GAAP. So when you ask your German controller, what are your book tax differences, the German controller is going to answer the difference between his GAAP, or her GAAP, and his or her tax return. Okay? But this isn't good, right? This is a disconnect. This is a major problem. Okay, and this picture is nice, but I think numbers will help. So let me create a little dummy slide that we can play with here. Okay, this is super fundamental. So let's say that Quinn is sitting there and says, my U.S. GAAP income is 1,000. Okay? And on the tax return, taxable income, let's say, is 1,200. Okay? So we're going to want to understand how to get from 1,000 to 1,200. Because when we file our 10K, that 10K is going to include this 1,000, right? So we need to start with the 1,000 because we're doing our U.S. GAAP provision, which includes U.S. PBT as our starting point. And our rate rec is going to start with that U.S. GAAP PBT, so we got to start with U.S. GAAP. Okay. But in effect, we got to get to German GAAP as a halfway point. Okay. So if you called up your German controller and you said, what are your book tax differences? Let's just take an extreme example. Let's say that the German controller said there's none. Okay? Because unlike the U.S., where there's a cajillion U.S. book tax differences, around the rest of the world there's not that many. In some countries there are no book tax differences. Whatever your statutory income is your taxable income. So it's very simple. So let's say you call up your German controller and he says, or she says, there's none. And then you would sit there, Quinn would sit there scratching her head going, well, how can this be? Right? Because my PBT was 1,000. I got that. That's coming in my GL system. Right? I can see it. But then the controller in Germany sent you a copy of their tax return and it says 1,200 of taxable income. And your controller is telling you there's no differences. Right? And so you're like, I'm pretty sure I'm good at math, at least to the extent I can solve that. And that does not work. So the question is, well, when you ask that person what's their book tax differences, you need to ask them what their book is. Right? And so in this example, there's a difference between GAAP and stat income. Right? So these will be GAAP. This is what's called GAAP versus stat differences. Okay? So you guys already know how to deal with book to tax differences, perms, temps, whatever, right? We talked about that plenty. But how do you deal with GAAP stat differences? So let's say that this difference is solely depreciation. Let's say that for local German, let's say that for local German purposes, depreciation is slower, and therefore you have more income. Okay? So how do I deal with that? I've got 1,000 of GAAP PBT, 1,200 of taxable income, and one difference, which is a GAAP stat difference for depreciation of 200. How do I deal with that? What is that? This is not a trick question, unlike those first 3 questions. What is that? What do I do with that? If I have a 100% tax rate, I know I have to credit my payable 1,200. All right? Do I have any deferreds? Yes, right? So this is going to drive a DTA. Okay? This is confusing because if Quinn's sitting in the U.S. and says, oh, I got a deferred tax asset, the German guy or woman is going to say what? I don't have any deferred tax assets. Right? And Quinn will say, no, you got to book a deferred tax asset. And the German person will be like, no, I don't have any book tax differences. I can't have deferred tax assets. And then Quinn ultimately will be like, you're not listening to me. Right? And the German person will be like, you're not listening to me. I swear I've been on that phone call many times. I always feel bad that I only speak English and I can't explain in their language, the issue. But you're talking past each other, right? It's true. Both of you are right. Right? The German person saying, I don't have any deferred tax assets for German GAAP purposes, because that's the world they live in. Right? As much as you want to lecture them on the fact they work for a U.S. multinational that files a 10K, that files U.S. GAAP financials, that's not their world, right? That's your world. So when that person says, no, I don't have any deferred tax assets, you'll say, yes, you're right. On your local financial statements, you have no deferred tax assets. Totally agree. But on your U.S. GAAP financial statements, you do have a deferred tax asset. Because when we file U.S. GAAP financials, we have a temporary difference between our U.S. GAAP PBT and U.S. taxable income. Okay? So the German controller will have two sets of books. This is true of every big company. They have two sets of books. They have statutory books and they have GAAP books. Okay? Oftentimes in Oracle or in SAP or whatever, they'll have kind of like a dummy entity code that will just have the GAAP stat differences, so that you combine kind of the one entity code for the business and the dummy one for the GAAP stat differences. You combine them and you got GAAP. Right? But everyone kind of does it different ERP style or ERP wise. Okay, but let me pause there. We got that? All right. If you walked out of the room right now, you would be better off than a lot of my clients. That disconnect, that ability to empathize with the other side and listen, what are they saying, right? That is the complexity behind form provisions. I know that's like completely disappointing and like anticlimactic, because you're waiting for like some technical rule or something like more exotic or interesting. That is what gets people sideways with form provisions. With, like, think stock comp. Stock comp, right? We had our stock comp class, number 5. Everyone was like, oh, this is horrible. I don't understand it. And then hopefully you guys felt like you could kind of understand it. In the UK, they have stock expense, or they have stock deductions too, and they have, for UK GAAP, they don't have 123R or 718 or whatever it's called. Now, they have FRS 20. That's what it's called there. So their book expense is called FRS 20. It's a different amount. So if our book expense for an RSU is, well, not RSU, let's use an option. If an option was worth 20 and we set up a DTA for 20 for GAAP, the measurement for FRS 20 purposes in the UK might be different. It might be 16. So now you have the confusing accounting for stock compensation where you're setting up deferreds and reversing deferreds and trying to track all these grants. Not only do you have it for GAAP, but you have it for local reporting, and it's different. So imagine having that conversation. Right? Because just accounting for stock compensation by itself is hard enough, let alone two currency, two sets of rules, two values. It is so confusing. Right? But it is not a technical issue. It's a communication issue, and it's a listening exercise to get on the same page with that other side. What I have seen so many times, and I mean I do this myself, is, you know, we have provision workbooks that we use for global clients, and we have a really dumbed down pack that we use for foreign provisions, and we color code it as kind of change this number or don't touch, right? It's like my kids, you know, no touch. And so we tell the foreign finance folks, we're like, look, there's 3 tabs that are input tabs for you. There's numbers that are shaded. You only change those numbers. It's like dummy proof, right? But it's dummy proof if you're thinking from a U.S. GAAP perspective with U.S. dollars, U.S. tax rates, U.S. rules. And then we send it to them, and then inevitably, right, they'll fill it out, and, you know, they'll fill out this. And we're like, no, we built this pack so cleanly so that you would have to bridge GAAP to stat and stat to tax, and yet they did not get it, right? Because they're approaching it from a completely different perspective, right? It's like driving on the right-hand side of the road versus the left-hand side of the road. It's like that fundamental. So I think I beat the horse dead at this point, but you get it, right? That is the difficulty in form provisions. And if you've never done one, and you do your first, I guarantee you that will be your problem. It happens all the time. one of my well, like favorite stories. This involved Lee, with our first guest speaker, and she got in like a full-on yelling match with her Irish controller, and you know, Lee's like 4'11" and like 80 pounds, and the Irish controller is like this dainty thing, and they're both just you know, and they're just talking past each other, and I'm just sitting there laughing, you know. There's nothing I can do. It's not a tax issue, you know, but that is the issue. Okay, we good? All right. You heard it here first. Okay, so next section. The next two sections are really more accounting based. So the first one, if we have foreign branch is a disregarded entity, it flows through to the U.S. That means that if foreign branch makes $100 of profit, that $100 profit is also going to be taxed in the U.S. Right? That doesn't sound good. It sounds like we're subject to double tax, right? So we are, but what happens in the U.S.? We get a foreign tax credit. So if on that 100 of income, country B assesses $30 of tax, then in the U.S. we have 35 of tax again, but we get a 30 foreign tax credit. We only pay an incremental 5. So in total we pay 35. That's the U.S. rate. So we're paying the higher of the two rates in that structure. That's how it's supposed to work. It gets way more complicated than that, but in the most generic sense, that's how it's supposed to work. Okay? Okay, so towards the end of the deck, we'll get into more detail on how accounting for foreign branches works. You see this some, not a lot, so we don't prioritize this kind of down the chain here. Okay, number 4. This is where all the action's at. U.S. tax on investments. Okay, so I mentioned earlier, this is USP's investments in Foreco and foreign branch. All right, and let's focus more on Foreco for this purpose. Okay. So let's do a basic slide here. Okay, so your reading tonight, your homework reading was Google, right? So let's say that we have Google, which is a U.S. company. It owns, we'll call it GNS. NUS, non-US. I have no idea what the structure is, but I'm guessing they got a foreign entity in there somewhere. NUS. Okay. All right. So on its U.S. tax return, who files an U.S. tax return? Is it G or GNUS or both? G, right? The U.S. taxes, U.S. companies, above the dotted line, right? Okay. So let's assume that the tax rate in GNUS is 5%. Okay, and the tax rate in GUS is 35%. Okay, you don't have to graduate from college to know you want all your profits in GNUS, right? So let's say that there's 100 of profit here, and we pay 5 of tax. We have $95 left over. Okay. What would we do if we got 95 bucks? What are we going to do? Okay, what are we going to do with the 95 bucks? Hello? What do I want to do with it? Oh, you guys are jumping ahead. I want to give it to my shareholders. All right? I want to buy back stock. I want to pay a dividend. I want to give my shareholders their money. That's what corporations are there for. Right? Form a company, you try to make your shareholders rich. That's the idea. Okay? So what happens if I want to give my money to my shareholders? Okay, so I'm going to make a dividend from this entity to this entity, and then presumably I'll make a dividend up to that, to the shareholders. All right? Okay, well, we don't care about the top one, but what about this middle one? What happens here? So if GNUS pays a dividend to GUS, G has USTI of basically 100. I'm just going to shortcut this. The US is going to tax you on the foreign income again. Right? It's going to say, okay, now you brought it into the US, we're going to tax you on the 100 again. Our tax rate's 35%. So that means our tax is 35. We get a foreign tax credit. How much is our foreign tax credit? 5. Okay? So we pay 30 bucks in tax, right? Okay. Do we want to do that? That's no fun. Okay. This is at the root of the issue, right? This is like the public policy debate on corporate taxes, right? The U.S. tax system is a worldwide, taxes worldwide income. So you bring your worldwide income into the U.S., it's subject to U.S. tax, right? There's other countries that are totally different than this, where if you paid a dividend from GNUS, and if G was, say, a Dutch company, then that dividend wouldn't be taxable to the parent, right? So again, if you keep your U.S. hat on, you just assume everyone pays incremental U.S. tax when you dividend to a parent corporation, but that's not the case around the world. That's a U.S. system. Okay? And so U.S. companies aren't stupid. They look at this and they're like, that's a lot of tax. I don't feel like paying that tax. So the obvious response is, I'm not going to repatriate it back to the U.S. Right? But when we're doing foreign provisions, we're going to look at this fact pattern and think, the question we need to ask is, do we need to accrue this? Do we need to accrue the 30? Right? Because we didn't avoid the 30. We just deferred it. Right? When all these big fancy companies have all their foreign earnings offshore, they haven't avoided U.S. tax. They just haven't paid it yet. Right? So when do they plan on paying it? Like when I regrow hair. It's going to be great. It's going to be an afro. So I make a joke out of it, but that's kind of it's somewhat of a joking matter, right? Companies don't plan on repatriating. So we'll talk about this in a few more minutes, but if you have a plan to basically indefinitely reinvest the earnings offshore and not repatriate it to the U.S., you don't accrue the 30. Right? There's a huge difference to your financial statements between accruing the 30 and not accruing the 30. Right? It is enormous. So if you looked at a company like a Google or an Oracle or an Apple, and you looked at the amount of tax that they are not accruing because they're saying they're indefinitely reinvested, it is staggering. And if they had to expense that in their financial statements would look totally different. Just totally different. I mean, it's almost like unrecognizable. I don't have the Google number at the top of my fingertips in terms of what their unremitted earnings are, but it's many, many, many billions, right? I remember when I was giving a lecture at another school on Apple, I want to say it was like 20 billion or something that they hadn't accrued, and that was in addition. Apple does it differently. They actually accrue some of this. They haven't paid it, but they accrued it. And but anyways, the difference between accruing and not accruing is just massive. And so the way that companies get low effective tax rates is through treating those earnings as indefinitely reinvested and not accruing the incremental U.S. tax. It's that simple.
What happens if they're expecting a tax holiday and something went this way, it's going to come down, and possibly instead of 30 they might end up paying less, and they want to get some money back, so they account or accrue for a little bit and not the entire part? So is it one of the, that's like Google doesn't do the entire, does not accrue the entire thing, but a little bit of it?
Well, so what Studi's mentioning is back in '06, the U.S. government did a one-time tax holiday for foreign earnings, and they basically said if you repatriate, we want money to come back in the U.S., hire U.S. employees to have U.S. jobs and reinvest in U.S. assets and that sort of thing. So we'll let you bring all your money back, and we'll tax you at a rate of about 5% instead of 35%. So all these companies are like, oh, we're not indefinitely reinvesting anymore, coming back to the U.S. This is great, right? And what Studi's asking for, or what Studi's asking about is, well, will they do that again, right? And a lot of the Valley companies lobby for that, but I mean, Obama's completely opposed to it, and it doesn't seem to have gained any traction in the last couple of years. But and the argument is that when all that money came back, it didn't necessarily do anything for the U.S. economy. The point of this class is not to talk about economics, but I mean that's an economic debate, right? And a tax policy debate. But right now, I think more so than a tax holiday, companies are holding out for corporate tax reform, right? So if you kind of read about what's out there for corporate tax policy debate, there's a couple of congressional proposals out there for how to change the corporate tax system, and the biggest part of it would be to change how the 30 works. There's a Republican proposal out there, there's a Democratic proposal that came out recently, and they're very different. But they address the 30, because the 30 is it's an elephant in the room sort of issue. Everyone knows it's there, it's huge, no one's paying the tax. You know, that's an oversimplification, but that's the fundamental thing. Okay, so back to form provision. So this slide has a bunch of current terminology on it. I think I've tried to highlight the main things to you. I can't say enough. Like the communication and the empathy, that is the biggest part of form provisions. Like we could talk about APB 23 and offshore earnings and that sort of thing, but that's pretty straightforward, and that's really a U.S. person's issue. That's not doing a big foreign provision with lots of foreign finance teams. That's a U.S. only issue. Okay, so the next handful of slides talk about APB 23. Before I get into that, any questions or comments on the first section there? Anybody worked on a form provision before? No? Is what I said true? No?
And my only comment is that 30 is a dollar method that you can grab like either dollar amount or a percentage of foreign earnings.
Yep, I'll try to touch on that in a minute. Okay. Okay, so we're talking about APB 23. APB 23 is now codified in ASC 740, but everyone out in the marketplace refers to it as APB 23 still. I think we've said this many times in class. No one in industry refers to ASC 740 ever. People always refer back to the old FAS 109 sites. I mean, that's what I know. I know all the paragraph numbers I need to know. FIN 18, for interim, FIN 48 for reserves, APB 23. That's how everyone talks still, even though this ASC 740 has been out there for like 4 or 5 years. I remember the first year I taught class after it was codified, we didn't even change the slides. We did use all the FAS 109 references. We changed them to include all the ASC 740 stuff because it seemed like malpractice at one point. But again, just so you know, as a practical matter, at least in Silicon Valley, everyone refers to the old citations for things. So if you say APB 23, tax people recognize it, controllers, CFOs, auditors. I mean, that is a well-known term. And that site is synonymous with I have offshore earnings and I don't want to subject them to U.S. tax. That's what it means. Okay, so here's the basic fact pattern. This is similar to what we went through before. The only thing that's additional on this slide is it introduces the term basis difference. So in my example before, I used my $100 of earnings, and I said what would happen if I brought my 95 of retained earnings, my net of cash earnings, back. So I was keying off of an earnings concept. And earnings, I think, for most people is way more intuitive, right? Offshore earnings, right? That just has a ring to it. People kind of know what that means. If I said, hey, what's your basis difference in your foreign subsidiary? You're like, I don't even know what you're talking about now, right? But this is how the accounting literature works. So let me give you book equity accounting 101 here. Okay. So no one does this, but this is how the rules work. If you have a fact pattern where you have P owns S, and let's say P forms S with $100. Okay, so we'll have let's have P's books here, S's books here, and a limbs here, and consolidation here. Okay, so P forms S with 100. So P debits investment 100, credits cash 100. S debits cash 100, credits equity 100. I want to eliminate my equity, right? I want to eliminate that, and I want to eliminate my investment. So I eliminate that thing. Because in my consolidated financial statements, nothing happened, right? I just moved left pocket, right pocket, right? So nothing happened. Okay, so I'm going to write over the top of this. Let's assume that S makes $10. Okay, S makes $10. S is going to say cash of 10, credits, income 10. P is going to say debit my investment another 10, credit equity earnings, which is an income statement account. So P's sitting there saying, I just made 10 bucks, right? My sub made 10 bucks, I own the whole thing. It's kind of like I made 10 bucks. That's how equity accounting works. So now, P's investment in S is 110, and S's equity, because this income is ultimately going to go into retained earnings, S's equity is 110. Right? This is like the core principle of equity accounting. P's investment in S is the same as S's equity. Okay? There's symmetry. But if I book these red entries, the S one's fine, but if I book this P one, I got to eliminate all that stuff. What is that? Right? That doesn't hit my consolidated financial statement. So I have to eliminate the investment, and I have to eliminate this equity earnings. So again, the only thing that hits my consolidated financial statements is that. But if I'm doing equity accounting between legal entities within my group, this is how I would do it for P and S. Okay? And at this point, you're probably wondering, like, why are we even talking about this? So the reason we're talking about this is the accounting literature, it focuses on basis difference. Okay? So if I asked, what is the basis difference in P's investment in S? I have a book basis of $110. What is my tax basis in S? 100. Right? I formed it with 100. So under 351, 358, I get 100 a basis. And then the 10 of earnings, that does nothing to my tax basis. So it means it's not subpart F. So my basis is 100 for tax. So I have a 10 difference. That is my basis difference in my foreign sub. Right? So it is way easier just to say I have 10 of offshore earnings than to go through all that stuff. Right? I have yet to see a company account for their subsidiaries on an equity basis in just this way. This is the rule. I don't think anyone debates it. No one does this in their bookkeeping. So if you went over to Kuwait and said, hey, you work at a big company, do you know what your basis difference in your subs are? You know, no. You can look up, you know, you might be like, oh, well, let's just look up in the ERP system. Let's see what the investment balance is that P has in S. Well, that thing's garbage. I don't know what that is. Usually it's, at best, it's like the original formation value. And even then, you know, I've seen them where they're negative and they don't make any sense. And so, because it's eliminated, the accounting guys don't care. It just doesn't make a difference to them. But when you read ASC 740 in the literature around how to account for P's investment in S, it assumes you know that you have a book and basis, a tax basis in S. And that's nice, but most people don't know what that information is. Okay? So these are the things that generally impact book basis and tax basis. So we're not going to go into this. I just want to give you some appreciation for actually, hold on a quick second. I need to pause for a quick second. Okay, so we were talking about the basis difference in the foreign subs, and I don't want to go any deeper into this other than to just make you aware of the concept of a basis difference that's different than unremitted earnings. Okay. For the rest of this class and our discussion tonight, we'll just talk about earnings, right? Because that's intuitive, right? I think everyone can get their head around the fact that there's $95 of offshore earnings that we don't want to subject to U.S. tax, right? But just know it's more complicated than that. These are the rules that deal with. These are the rules that deal with the outside basis differences. You know, this can be a little confusing depending on what your fact pattern is. These are the old FAS 109 sites with the ASC 740 sites below it. But like paragraph 31 of FAS 109, that was the rule that said no DTL if you're APB 23. If you're essentially permanent, right? It's not exactly the language that I think is the preferred language, but indefinitely reinvested is probably the preferred language. Okay, so paragraph 31 is the rule that says if you have a, note it's a foreign sub, right? So an important distinction there is it can't be a parent that owns a sub in the same jurisdiction, it has to be foreign. So parent has to be in one country, sub has to be in another. Domestic subs. So paragraph 32 and 33 deal with domestic subs. And what that rule basically says is you have to have a DTL. Okay? So then some people would read that and they'd be like, oh, this is not good, right? If I have a U.S. company that owns another U.S. company, and I have a basis difference in that sub, I guess I have to accrue more U.S. tax for that basis difference. Right? But paragraph 33 says nah, don't worry about it. No DTL if you have the equivalent of like Section 332. You could just make that basis difference go away. Okay? Massive oversimplification there, but know that in most jurisdictions, if you have companies in the same jurisdiction, there's not a tax effect of one company's investment in the second. Normally those things are eliminated. So the U.S. system of consolidated returns is a little unique in 332 and provisions like that. But in most countries, if a UK company owns another UK company, there's not going to be a parent level tax. So this discussion comes up every once in a while because people distinguish between that top rule where APB 23 can apply to a foreign investment, where APB 23 cannot apply to a domestic investment. And then paragraph 34 is not DTLs, but DTAs. Okay? So how could you have a DTA? How could that happen? Anyone? Sub-loss money, right? Sub-loss money, you take this fact pattern, you flip all the signs. If you flipped all the signs, book basis wouldn't be 110, it'd be 90. Oh, whoops. It'd be 90. So this 10 would be tax greater than books. So the theory would be if you just sold your asset, your investment in sub for book value of 90, you'd have a tax loss. What paragraph 34 says is you can't book a DTA unless you're going to realize it in the foreseeable future. So the rule doesn't work in parity with the DTL rules. You can only book a DTA if you have a plan to realize it. Most companies would have trouble satisfying that requirement. Okay, this is the final slide on this kind of methodology topic. In this slide, as you can see, I just created right before class. What this slide is basically trying to say is, if you were not indefinitely reinvested, so you are not going to apply APB 23, in my example earlier where I was scratching out that company with 95 of offshore cash and offshore earnings, the question we were asking for that company was, should we accrue the 30 or not? And in that example, it was really simple. The 30 was the obvious question. Bless you. But what if your book earnings are 95, but let's say your E&P is only 60? Right, your tax E&P. So when somebody says, what are your offshore earnings? What's the answer? Is it 95 or is it 60? If you read Google's 10K and they have a disclosure in there of their unremitted earnings, what is that? Is that 95 or the 60? No, this one's a trick question. It depends. Companies differ on what they disclose. The answer is, what they disclose should be the basis difference. That's the technical answer. Hardly anyone discloses the basis difference. At least that's my experience. Most companies will either disclose retained earnings or some sort of modified retained earnings number, which would be the equivalent of the 95. Some companies disclose E&P because tax people know what E&P is. They've calculated it. They're tracking it. They got a lot of visibility on that number. Where if you went to the International Tax Planning Group of, Oracle, and you're like, hey, what's your basis difference? They're probably like, I don't know, but we're planning for E&P, and we kind of know what our E&P and tax pools are, and the whole concept of a basis difference is it's just not at people's fingertips. So the point of this slide is, for companies that are accruing some or all of that 30, it's not a basic question of how to do it. Different companies would calculate it different ways. And this slide is trying to show you that, well, if you were going to accrue the 30, you have to decide, am I accruing based upon a hypothetical dividend that is defined by a basis difference, that's defined by book income, that's defined by E&P? Which one? And then the second aspect of that calculation, if you're accruing the 30, is embedded in that 30 is a foreign tax credit. You have to decide, am I accounting for that foreign tax credit based on the credit that would go on a return, which is more of a tax pool number, or am I using like a provision number? Right? So let's say my foreign provision was 5, but I only paid 3, and 2 of it's going to be deferred. So when I plan on repatriating those earnings, should I plan on a 3 foreign tax credit or a 5 foreign tax credit? Right? If I actually paid a dividend, I'd only get 3, but my accounting would suggest 5 would be the consistent number. So this gets really confusing. So if you've ever worked with a company where they're not permanently reinvested and they have offshore earnings and they accrue for this DTL, actually calculating what the DTL is complicated. I spent about probably 6 weeks with one company, pretty much at their office every day, big company, trying to figure out how to calculate their 30. I remember I was friends with the tax director there who was in charge of the provision, and as she started and she got a hold of their calc, and it was giant Excel files, and it was one of those, this is how we do it, but no one really understands it. And so we kind of stopped, and we didn't use this page, but we kind of looked at this version of a version of this kind of a chart, and we said, well, where do we want to be in these spectrums? Like, if we're accruing U.S. tax on our unremitted earnings for U.S. GAAP accounting, how do we want to do it? Right? So let me give you some examples, because this is either interesting to you or you're like, stop. Okay, so I'm P, I got foreign sub. Makes $100, has a 5 provision, 95 of cash. Okay, so if we stop there, we all know what to do, right? Okay, but let me throw out like some different facts. Let's say that let's say that there's a stock comp deduction of 10, and therefore my E&P becomes 85. Right? Do I look at the 95 or the 85? So let's say there's a FIN 48, and the only reason FS got 100 is probably because it didn't pay P enough. Right? The IRS would be like, hey, hold on a minute, FS is getting too much money here. FS's profit shouldn't be 100, they should only be 75. So let's say there's FIN 48 of 25. So what do I use? Do I use my 95 or do I use 70? You know, exclusive of my stock option issue. You know, if my current provision, my current tax is only 3, what do? Right? That affects my E&P. My E&P only goes down by 3, not 5, because I only paid 3, not 5. So now my E&P isn't 95, it's 97. So again, if you were calculating your 30, right, what would happen if I brought this back, you really have to ask yourself, are you doing this under a book method or a tax return method? Because calculating this under a book method, using all these kind of book assumptions, it gets really theoretical, really confusing. And when you talk to the people on, you know, either the firm that does your return or the people in-house that do the planning, they're always going to be thinking of this. And so if you as a provision person are calculating your accrual on this basis, it gets extremely complicated to bridge those two worlds. This is truly one of those topics where you can't appreciate it until you like suffer through it. So worry about listening to your foreign controller. Don't worry about this one. Okay, more on APB 23. So here's the rule. The rule is, if you read the the accounting guidance, it says the default is you're assumed to have the non-U.S. company pay a dividend to the U.S. Your starting position is you will repatriate. So you should accrue the 30. You can rebut it and say that, no, I'm going to be indefinitely reinvested. And if you provide sufficient evidence to show that, then you don't accrue the 30. So that's the way the rules work. So these are the things you need to document your APB 23 position. A big part of this is intent, right? So one of my clients, I like to pick on them when I'm talking about this topic. In fact, I was at dinner last night with one of the, he was a big wig at the IRS dealing with companies that have offshore structures, and he just joined Deloitte. And we were talking about how the IRS was litigating with certain companies on their transfer pricing issues. And I was asking him like how the IRS passed up some of these Silicon Valley companies that were good targets for litigation. And we talked about one of my other clients. We were at dinner with a client, but we talked about a different client on a no-name basis. And this client was a U.S. company that owns a Cayman company. And all the people who work at this company reside in the U.S. Okay? My client doesn't actually make anything. They just design chips, but they use a contract manufacturer to make the chips. So they're a fabless chip company. So the U.S. and the Cayman company deal with the contract manufacturer. They say, make our chips, blah, blah, blah. All the people that work at this company work in the U.S. And then our sales, about 5% of our sales are to U.S. customers, and then about 95% of our sales are to Asia. Okay. So in our business, we have essentially, this is oversimplifying it, but we have 95% of our profits sitting in this company. Because we did our IP buying a long time ago, and all of our non-U.S. IP is sitting in this Cayman company. So our non-U.S. business is run out of this company. But there's no office, there's no big building, there's no smoke coming out the top, there's no there, right? Again, I'm oversimplifying it. This company as a whole makes a ton of money. I mean, they're very profitable. So they have lots of cash, right? Cash. Okay, so if somebody said, hey, the rule, like I learned in class, that the rule is you have to assume that you're going to repatriate this cash. Unless you can indefinitely reinvest it, right? So what is my company going to indefinitely reinvest in? I have a Cayman company that, like, who knows what that even really means, right? If you go to the Cayman Islands, there's not, I mean, I've been there, there's not a ton of companies that are, it doesn't look like a Google campus followed by a LinkedIn campus on the Cayman Islands. So you got a Cayman company, it's got a ton of cash, it's got no people that work for it, it doesn't manufacture, it uses a third party to do that. So how is that company going to indefinitely reinvest? Well, part of it is management's intentions. What does management intend to do? Well, I can tell you what, I know that company really well, and they don't intend to pay tax. And you could debate that all day long from a tax policy perspective, but they do not intend to pay tax. Right? And when, I like to talk about how when John Chambers goes on 60 Minutes, he's done it twice, and he goes on there and he says, we have all these billions of dollars of offshore earnings, but we're not going to pay U.S. tax on them. The U.S. tax rate's too high. It's unfair. We don't like it. Right? I mean, there's no more explicit way to demonstrate management's intentions than to have your CEO go on 60 Minutes and just tell the world. Right? So management's intent is a huge thing. When you talk to your auditor, they're not going to want you to say, well, do you feel like paying tax? I mean, like, that's not how the conversation goes. But that's how it works. Right? In my client, this Cayman company with John Chambers, I mean, it's all about the tax. It's not necessarily about the reinvestment, although there's a part. But I guarantee you, like, PwC is Cisco's auditors. So I guarantee you, I think, so when you go to Cisco's auditors, they have to document why, when Cisco says we're going to indefinitely reinvest, why that's reasonable. Because they're auditing the, accuracy of those financial statements. And Cisco can't just say, like, memo to PwC from Cisco, we don't want to pay tax. Right? That's not the way the memo reads. The memo reads, we're going to build stuff offshore. We're going to buy companies offshore. We're going to hire people, and we need working capital. We're going to grow the business, right? We got investment plans. They're going to say these things. So like my Cayman company, they'll say, you know what, we might buy some other companies. We'll buy them using our Cayman cash. We'll buy them offshore. And in fact, they did. They bought a company about 18 months ago for like $150 million. And they were funny, right? When they bought that company, it was a nice deal for them. But they were also like, I told you, see, we're going to use our non-US cash. And they found a way to do it. But that's a prickly issue, because the standard is an intent-based standard, right? You have to have the intent to reinvest offshore and have to have the ability. So if your U.S. company was bankrupt and needed money and you were screwed and your shareholders were mad and all your foreign entities had all this cash, you don't have the ability to reinvest offshore. You got to bring it back to the U.S., right? If you're, Google, you'll sit there and say, well, I got a ton of cash in the U.S. I got a ton of cash offshore. I don't really need it anywhere. So I might have the intent to invest offshore, and I have the ability. I'm all good, right? So the memos that companies write for their auditors on this standard will reflect the company's views on their intent and their ability to reinvest indefinitely offshore. And the questions you need to answer in there are, why do you need the money outside the U.S.? And why do you not need it in the U.S.? You have to answer both. In fact, at that TEI thing on Thursday, at the very end, they did this questions from the audience thing with all the firms sitting on stage, and somebody asked the question, if you don't need the money in the U.S., is that good enough? Right? And the answer was clearly no. But the question was asked from a very pragmatic sense, because somebody's like, well, I don't need money in the U.S., I don't want to pay the tax. He didn't say I don't want to pay the tax, but that's what he meant. Right? He's like, I don't need the money in the U.S. Why would anyone pay the tax? So I'm good, right? And although as a very practical matter, that's like most of it, that's not the way it gets documented with the auditors. Okay, so these are the things you need to look at, factors in assessing APB 23. And one of the factors, if you actually read APB 23, it would acknowledge that this item F, tax consequences of the remittance, is a relevant factor. No one likes to talk about that as part of the audit documentation, but it's acknowledged as a relevant factor. And it's last, even though in a lot of companies' minds it's first, but it's last on the list. Okay, so every company that asserts APB 23 has to disclose this stuff in the financial statement. So every 10K you guys have seen throughout the course, you've seen this. Right? Required disclosure. The one thing I think, So this year your homework was Google. Last year when we did this class, the homework was Microsoft. And I remember reading Microsoft's disclosure before class, and instead of them saying our unremitted earnings that are indefinitely reinvested are X, what Microsoft said was, we have a temporary difference for which we don't have a DTL of X. And as a tax accounting person, I'm like, that's fascinating, right? I'm sure like most non-tax accounting people, which is like everyone else in the world, would be like, what is that language, right? I mean, it's very confusing if you're not one of us. But that language to me, and that was the first time I ever read it in a 10K like that, it was clear that they reverted back to the basis difference concept, probably at the urging of their auditors, which is Deloitte, which is not me. But it's interesting because that's one of those like manifestations of there's the accounting rule. The rule is very much a basis difference. What's your basis difference in a foreign sub? That's the rule. And so maybe they felt like they were being compliant with the rule. But again, there's kind of you kind of like your financial statements to be understandable by just the ordinary investor. And I don't know how many times an ordinary investor would have to read that before they would process exactly what that meant. Right? It's certainly hard to be very practical about that. But anyways, these are the disclosure requirements. You basically have to say that you have an earnings that are or a basis difference that's indefinitely reinvested. You have to disclose the amount of that basis difference of those earnings, which is this item B. And then the real zinger with this is you have to disclose the unrecognized DTL. So that's the 30 in my example. So in theory, if you were doing like super plain English, you'd say, I have offshore earnings, I'm reinvesting them indefinitely. If I did bring them back, it would cost me 30 in US tax. Like that would be the English version. If you read most companies, it's not that straightforward. Plus you don't know whether that number includes basis difference concepts or E&P or book concepts or stock option amounts or FIN 48 or currency differences. I mean, what that number is like your guess, you know. And so you're using it as like a directional barometer as opposed to like some kind of precise number. But the number that's being disclosed is this. It's the temp difference amount related to the earnings. It's not the unrecorded DTL. Because most people say, I have unremitted earnings of 95, and the tax effect of repatriating that 95 to the U.S. is not practicable. That's what most people say. And one of the reasons I picked Google for the homework was Google got an SEC comment letter from the SEC, and one of the SEC comments was, hey, how come you say it's not practicable? Right? And the real answer is because the rules say I can say it's not practicable. Right? Because this slide is the rule. This is not like my language. This is the rule. And the rule says you can either say the 30 or you can say it's not practicable. And it's not elective, meaning if you knew the 30, you should say the 30. But if you don't know the 30 because it's complicated to calculate it, you should say it's not practicable. So the SEC had this funny exchange, or at least it's funny to me, had this funny exchange with Google, and they said, hey, how come you said it's not practicable? And the Google response was, because it is. And then the SEC was like, no, really? Come on, you can figure it out. And these are my words, right? And the Google response was, no, we can't figure it out. And they said, why would we? We're never going to repatriate. Like, never. So we don't care. Like, it might take us 45 minutes, but why waste the 45 minutes? It's totally irrelevant. Like, that money is not coming back to the U.S., so therefore, we're not even going to lift a finger to calculate what the hypothetical cost is, because it's just an irrelevant concept. Right? It's like arguing with my kid about an ice cream only diet. It's not even worth the conversation. We're not going to have that. Right? Like, that was kind of the response. And then the SEC kind of dropped it. And you're like, oh, that's interesting. Right? So, I mean, all the SEC comment letters are public information. You can go look them up and see kind of what the back and forth was. It's very interesting. And they were one of the first ones. Like, if you thought of a Silicon Valley company that you're familiar with, and you thought, I wonder if they got SEC comment letters, they probably did. But Google was one of the first. And so their response back and forth was really interesting because their style seemed to be fairly confrontational with the SEC. And that's probably not the correct way of representing it, but a lot of people, when they respond to SEC comment letters, will say, good point, I'm glad you brought that up, I hadn't thought of that before, I'm going to reflect something different in my SEC filings in the future. You know, again, thanks for really looking after me. And Google was like, no, right? Because it was kind of a please do this, and they're like, no. So, anyways, if you have intellectual curiosity, pull that up. Okay, so that's ABB 23.
When the subsidiary repatriate money back to the parent, so what will be taxes? I mean, is there any other way to repatriate money, like you transfer a parent, transfer a patent from the parent to the child, then it's more like a transfer person. So is it a better way to repatriate money?
Ma'am, good question. All right, so who did the reading? What was HP doing? Okay, so what I sent you in that email was, again, it's all public information, but it was a Senate subcommittee investigation memo. So Carl Levin, who's a Democrat from Michigan, he heads this committee, and this committee did an investigation on U.S. multinational companies and what their tax structures were. And the subcommittee investigation was all premised on the fact that big U.S. multinationals aren't paying a lot of U.S. tax because they have these sophisticated international structures. Right? And so they did an investigation originally of Microsoft and HP. And then they had Microsoft and HP testify and in front of Congress. And so that's available on C-SPAN if you want to go dig it out. It's super interesting, if you ask me. You know, I don't think as a tax person you ever think, like, I'm going to be sitting in front of Congress, like, on C-SPAN, explaining, like, my tax structure in a completely hostile environment, right? Like, that sounds interesting, but if that was you, that's probably terrifying, right?
Is this the same one that Apple?
Apple did theirs last spring. They testified in front of Congress as well, but HP and Microsoft were, like, 12 months ahead of them. Yeah. So, again, I realize, like, if you've learned anything from this class, you realize I'm, like, a super nerd. And when I remember when that came out, I was like, I'm watching this. And it went on for hours. Oftentimes, like, on the weekends, I work at our swim club because the kids are, like, crazy at home. So I just go to the swim club. And I remember watching this for, like, 3 hours at the swim club. And I emailed a buddy of mine. I was like, you got to see this. And I'm like, look what's come of us. This is horrible, right? That's what we're talking about. But the head of tax of Microsoft, the head of tax at HP, both testified about their structures. And what HP was doing, and this is summarized in the memo. This is kind of a long way back to the reading. HP had 2 foreign subs. They had lots of cash in both. And they were loaning money from one up to the parent. But if you do that for a long period of time, the U.S. tax rules will cause that to be treated as a deemed dividend. That's 956. So they'll say, if you just loan money to the parent, that's just a dividend, because it looks like you're hiding a dividend, right? But if you make a short-term loan, then it's not a dividend. Okay? And these rules eased with the financial crisis for a while, too, that made this a little bit more fruitful. But so the foreign sub would lend money to the U.S., and let's say it was for, I don't remember the increment, but let's say it was for 60 days. And then P would pay it back. But then at the same time, P would borrow from this entity. And when this entity's 60 days were up, or whatever the time period was, I think it was longer, P would pay it back. But when P paid it back, it got another money from this guy. So it was doing alternating loans between foreign subsidiaries that had lots of cash. And that might seem trivial, but each time they were doing these alternating loans, I want to say that the float that they kept here was like somewhere in like the 5 to 10 billion range. Right? So that they were keeping money that was the money of a foreign sub in the U.S. at all times, or at most times. Because one of the things that Congress was doing in the testimony was trying to show that there was always this amount of money in the U.S. in some way, like the program was so rigged. Right? And so in the memo, they describe the structure pretty clearly, and in the testimony, they kind of describe it pretty clearly. The rules, I mean, HP has pretty unique facts in that they have these kind of dual offshore earnings pools, and the rules have been tightened since they were taking advantage of this. But what was the most fascinating thing about the testimony was who testified after the head of tax of HP? Anyone know? It was the tax partner for EY that was auditing HP. Because what did HP say on their financial statements? They said all of this was APB 23. And the Congress was beside themselves. They're like, okay, so you're saying you're permanently reinvested, or you're indefinitely reinvested, but yet you're constantly loaning money back to the U.S. Like you're making a mockery of the accounting rules. And so then when the EY person took over, and this is not personal to that person, by the way, you know, the question of that person was, well, how could you say that you were indefinitely reinvested? Like, how could that be? Right? Because the tax policy view of this is, so if you're sitting in Congress and you're like, oh, companies are killing us, right? What Congress would say in part is, you know, APB 23 made me do it. I wanted to reduce my earnings because I wanted to reduce my tax expense because that allowed me to increase my earnings. The way to do that was to argue indefinite reinvestment. And what companies are trying to do is they're trying to keep this and basically turn this into a standard where as long as there's no U.S. taxable income, then you must be APB 23. Right? So as long as you're able to not subject those earnings to U.S. tax, that is synonymous with indefinitely reinvesting. Because what HP could say is, we followed the law allowed us to do this, we weren't bringing our money back to the U.S., we were loaning it temporarily over and over again, but again, we weren't actually resulting in any U.S. tax, so we're indefinitely reinvesting outside the U.S. It's just in the U.S., outside the U.S. Right? Very confusing. And there was not much that the EY person could say other than they're not triggering U.S. taxable income. They have a plan not to trigger U.S. taxable income. The money is not permanently coming back to the U.S. It's just through this temporary kind of alternating loan arrangement. It just doesn't look right. But not looking right doesn't mean the accounting rules change. So, I mean, we could debate that all night long, but that memo was, I thought, a pretty good summary of what two big companies were doing, and they were doing very different things. And one of the big pressure points in that whole Senate investigation was APB 23 the right thing to have out there for companies, or is it causing companies to do unnatural things because they're so hungry for earnings? And some companies wondered whether, you know, there would be pressure on the FASB to change the rule out of this, and nothing's changed. But that's what that kind of subtext was in that memo. So I don't know if the video is still there. It probably is, but it's pretty interesting. And the part where Lester, who was the head of HP Tax, and then the guy from Microsoft, it was maybe an hour tops just of that. Most of it was like there were some Senate speeches, and then there were some economists that came and talked about different tax policy arguments. But if you just listen to the piece with the HP and the Microsoft guy, that was like an hour. Okay, that's APB 23. Anything else?
It's like for still the repatriation of money. I mean, if for some offshore that transfer money to activate another corporation, and he acquired a corporation in so is it kind of a way that the sub repatriating money actually needs to know?
I'm not sure I follow you. Say it again.
I mean, if the sub uses money to help the parent to make an acquisition, and after if you acquire the targeted company is in U.S. So is it a way that because the parent didn't do anything and the retirement sub pays for all the acquisition costs and huge money to
Okay, so the short answer is that generally only works when the acquisition is of a non-U.S. company, not of a U.S. company. So if we wanted to use a non-U.S. company's money to buy a U.S. company, that would create other tax issues, which we don't want. So like in that other client's example I was telling you about before, they bought a Swiss company with their Cayman company's cash, and they were using money outside the U.S. to invest in other non-U.S. assets. But if your Cayman company invests in U.S. assets, you have a problem. It creates a deemed dividend, sort of like this alternating loan situation. But, as you can imagine, there's so much money out there in non-U.S. entities that the two hot areas within tax are what we're learning here in class and how to solve that problem. Like, those are the two hot areas. So if you came up with a solution for that, you will be fully employed and all your wildest dreams will come true.
What I heard that from the acquisition of Microsoft to Nokia is that Microsoft used up a lot of its offshore cash to make an acquisition.
Okay, could have been. Nokia's a non-U.S. company, right? Microsoft has a lot of non-U.S. cash. Okay, so so far tonight we've learned about how to do a foreign provision mechanically, how to sympathize with our brethren offshore. All right, it's huge. We learned about APB 23, right? Those are the two kind of main drivers so far. The next two topics in here that I've included kind of just briefly on the slides. The first one is currency. Currencies are interesting. To me, currency, it seems like it's outside the comfort zone of a lot of people. And I think it's just because, we get used to kind of dealing with dollars and the numbers kind of in our calculations that we're familiar with. And when multiple currencies get involved and somebody says, I have a foreign currency effect, boy, it can be confusing what that is. Because there's many types of currency issues out there. And what I would encourage you to do, if anyone ever says there's a foreign currency issue, slow down and understand what it is. Okay? Because there isn't just one kind of foreign currency effect. There's many. And I think that, especially as a young person where you're unsure of yourself and you're learning, and somebody else says, oh, that's just a foreign currency effect. Like, you probably get the impression that they know what they're talking about and you don't want to say anything because you'll look stupid and the person will be irritated, right? There's a good chance that person doesn't know what they're talking about, too. Like, sometimes when a provision's going totally awry and the rate rec doesn't work, like, I'll joke around and I'll be like, it must be foreign currency. And we'll be doing like with just a U.S. provision, right? So the joke is it can't be currency. But people will be like, well, yeah, it's probably currency. I don't know. It could be currency, right? I'm like, that's what happens with currency. It doesn't make any sense, right? People are like, yeah, I guess it could be. It's so complicated, no one knows. And so as you learn about currency issues at work, you know, make sure you pause and understand, well, when you say it's currency, what do you mean? Right? So you'll see on this slide, I say there's transaction gains and losses, and there's translation gains and losses. And those things are two totally different things. Okay? But both can have foreign currency effects. Okay? And you will go, you know, I've seen so many like currency presentations where people will be like, yeah, this is translation, there's transaction, and there's this, and you understand, and next slide, you know. So let me just try to explain, give you some examples in like a really, really basic sort of way. Okay, so let's say that I'm a U.S. company, and I have a UK sub, and I have a customer in Germany, Okay, my functional currency here is the pound, dollar, and that customer is going to pay me in euros. Okay? And you probably think like, oh, really? There's three currencies? It happens all the time. Right? This is not uncommon at all. So, let's say that the customer sells or the UK company sells the product to the customer for 100 euros. So on day one, 100 euros, let's say it equals 100 pounds on day one. Okay? So we sell the product for 100 euros, it's 100 pounds of income, and on day one, 100 pounds equals, let's say, $130. So on our 10K, we book $130 of income. Okay? But in reality, we're owed 100 euros. Okay? So in our U.S. financial statements, we've booked a receivable in dollars for 130 because we file a 10K in dollars. We booked income for 130. So let's say on day two, Germany pays the UK 100 euros, and now 100 euros. Let's say that's 105 pounds. Okay. So I thought I made a sale for 100 pounds, but actually I got 5 pounds more, so I've gained. Right? So this entity's got a 5-pound gain. Right? And that 105 pounds, let's say ultimately becomes worth $140. So in year one, I booked that to my income statement. Cumulatively, by the time I got paid up, I recognized that. So there's a 10 transaction gain. Right? So in year two, on my 10K, I'm going to book 10 of income. Right? And that effect will roll through my UK provision because I'll have more pound taxes because I had more pound profits. Right? So that's a foreign currency transaction gain. And a transaction is it's a transaction in a currency that is not your functional currency. Okay, so I bought inventory, or I had a related party accounts receivable, accounts payable, I made a loan. It's in a currency that's not your functional currency. Okay? Make sense? Okay, let me give you a totally different kind of example. This is like, as one of my clients would say, like a 360-degree difference. That's supposed to be sarcastic. Okay, so let's say you're US, and you have a foreign sub that you've checked the box, and it's UK, and you formed it with $100, and on day one, $100 equals 100 pounds. Okay? You form your UK branch, no big deal. Day two, that same 100 pounds is now worth $125. Okay? Pound is strengthening. So, what's book going to do? Like, we haven't even had a transaction. We're just sitting on money, right? We funded the company with $100. They said, all right, well, we're going to be a pound company, so we got to go do a bank and convert it to pounds. We're just sitting on our pounds. We're doing nothing. But now those pounds are worth more dollars because the exchange rates move. So on our 10K, we're going to show cash of 125, right? Because we have a pound asset that's now worth $125. But last year, we just had 100 of cash. So somehow on our 10K, we have to debit cash 25 and credit something else 25. And this will be CTA or OCI or both. Or CTA is a component of OCI, which is equity. So we just had 25 more cash because our the currency rates moved in our favor in this example. Okay, so then what happens on date 3 if we give up our 100 pounds back to the US? What if we just said, oh, we're not going to actually run that business, forget it. We'll bring that money back to the US. What happens for tax purposes? We have a Section 987 gain. So for tax purposes, we got $125 back as a remittance. But we had only never invested 100. So we had a 25 gain. That gain is translation, right? But we realized it. So it's taxable. For book purposes, that's translating a balance, and they're booking it to equity. Whereas in this other example, when this 10 happens, this 10's going to the P&L. This transaction item books as booking to the P&L. Okay? So just those two fact patterns, and there's many more, should illustrate to you, wow, those things are nothing alike. Right? Those two fact patterns were extremely different. So when somebody says there's a foreign currency issue, your response, like, don't worry about those two fact patterns because there's many more. Worry about, well, what do you mean? Tell me more about it. Like, which currencies are our entities in? Which currencies are the assets or transactions in? Which way is the currency going? And if you feel like you're going slow and understanding it, that is normal. I mean, I sit there with other, like, some of the top partners in the firm, and we sit there and we're like, well, which way is it going? Is it up or down? Or, you know, when somebody says the currencies are strengthening or weakening, you got to, like, put your head around, like, whose perspective you're talking about. It takes a while to process currencies. So just go slow and understand.
So if there's like a foreign tax credit account and then a related account that's for that same foreign tax credit but FX. So if the tax consequence, it depends on what that foreign tax credit is for. What is that effect? Is that translation or is that transaction?
I'm not sure I follow your example.
Like if there is an account for foreign tax credit for the FX, for the foreign currency, fluctuation in foreign tax credit, is that going to be considered translation?
I'm not sure if I know what you mean, but let me speak to like the general topic for a minute. Okay, so let's say you're U.S. and foreign, you're UK. You've made £100 of profit, paid £20 of tax, so you have £80 left over. Okay? So, if you were to repatriate, if there was no currency differences, you would assume you'd pay an incremental 15 of U.S. tax, assuming that the exchange rates are 1 for 1. Right? But when you repatriate, you do two things, right? You pick up a dividend equal to E&P. And then the second thing is you take a foreign tax credit for the taxes paid by the foreign sub. This amount is kept in FC and multiplied by FX at the date of the dividend. So you would say that £80, I'm keeping it in £80, and whenever that £80 comes up, it's taxable to me in the US as a dividend at £80 times whatever the pound-dollar exchange rate is at the date of the dividend. Okay? But my foreign tax credit, it's translated to dollars at spot, at payment. Okay? So let's say our facts are year one, the exchange rate is 1 to 1. And so this is when taxes paid of £20 equals $20. And let's say when the dividend is paid up, it's £1 to 70 cents USD, which I know is the opposite what you expect, but it's going to illustrate my point. So if I bring back the £80, then the way the calc's going to work is I'm going to have dividend income of 56, which is 80 times the 70 cents. I'm going to gross that up for my foreign tax credit, which is maintained in dollars. So I'll have U.S. taxable income of 76. 76 times 35% is about 26. I get a 20 foreign tax credit. Again, that's kept in dollars. There's no translation effect to that. So I only have to pay 6 of U.S. tax. So I kind of got a great deal, right? Because back when the exchange rates were 1 to 1, I should have paid 15 of U.S. tax. But because the dividend is translated at the FX rate at the date of the dividend, whereas the tax pool's kept in dollars based on the date it's paid, you get currency arbitrage. So I have no idea if this is actually addressing your question, Quay. But this is another example of, oh, that's a currency effect. Right? If somebody says, oh, I thought the tax rate difference was 15%, you'd expect a 15 tax, but here it's 6. Because here I favorably arbitrage the currencies. At least for tax purposes. I screwed myself economically because I should have hoped to get $100 out of this company when in fact I only got 70 cents. But you're like, yes, I saved tax. Right? Losing money will save tax, 10 times out of 10 usually. So, again, I'm not sure if I answered your question, but this is yet another currency effect, right? And this one probably seems like it has no relationship to the other ones we talked about. So, I'm not sure if I answered your question, but the moral of the story is always slow down, understand what's going on, make sure you get the economics. Currencies are hard to learn through just like slides. I mean, we've done entire multi-hour presentations just on currency issues. So kind of tonight, yeah, I guess the thing I would kind of point you to last is just this slide and this one right here. You know, if you get these terms, local functional reporting. Reporting is obviously what your 10K's in. Functional is what you run your business in. Local is, if you're a UK company, let's say, and your functional currency is the dollar, because you do business in dollars. Well, when you file your tax return, the UK government's going to be like, yeah, that's great that you do business in dollars, but guess what? We're in the UK. So if you could just go ahead and file a pound tax return, that would be great. Right? You don't get to file a tax return in every currency you feel like. So the local currency is pound. Right? It's just that simple. So local is what the local tax authorities will care about. Functional is what you do run your business in, what you keep your books in. Reporting is what your 10K's in. Okay. So somebody's going through a currency issue, say, all right, let me get this straight. Like, what's our reporting currency? It's dollar. Okay, what's our functional? You know, what's our local? What's the transaction in? Which direction are the signs going? Right? Just ask questions and try to process what the facts are. Okay, last section, and then we'll kind of freelance a little bit. Branches and hybrid entities. Okay, so I'm going to cover this in like 5 minutes. Okay, so let's say this is our fact pattern. U.S. parent owns a Canadian branch, makes $1,000. In Canada, the tax rate's 30%, the U.S. tax rate's 35%. So, we would expect to pay $300 of tax in Canada. We would expect to pay an incremental $50 in the U.S. after the foreign tax credit, so that we get a 35% tax on a worldwide basis. Right? Easy. Okay. So, when you start throwing in deferred taxes, things get complicated. Okay? So, let's go to an example. So let's say that Canada didn't make 1,000. Let's say it lost 100. Okay, so Canada has a loss on its books of 100, and if we do the Canadian provision, this is it. Right? Debit, we have no payable, we lost money. We have a deferred for 30 because we have a $100 NOL carry forward in Canada at a 30% rate. So we have a 30 provision benefit. So this loss flows through to the U.S. because of the circle in the box, which means it's a flow-through entity. So we do our U.S. provision. We're going to reduce our provision or our payable by 35 because we have a flow-through loss. We're assuming the U.S. is profitable. We don't have any deferreds. So we got a 35 benefit. All right, this is awesome. Like the heck of that APB 23 planning. This is even better. All right, we got one benefit here, and then another benefit here. That's good stuff. Okay, is that right? Of course the answer is no. So what do you do? What's the solution? Why is that not right? Other than it just doesn't feel right. Bless you. What will happen next year? Okay, so I like writing new slides so that you don't just cheat and see the solution. What will happen next year? So assume we did that. We booked that double benefit. What happens next year if Canada makes $100? If Canada makes $100 next year, we'll credit our DTA 30. We'll debit provision 30. Makes sense, right? Benefit to build a DTA, detriment to run down a DTA. So in the US, if Canada makes 100, well, we're going to credit our payable 35. So I guess we need to debit our provision 35. Well, this is not good. This is not how it's supposed to work. We're supposed to pay the incremental tax, right? We were supposed to pay like 5%, not 35%. So why are we paying 35 here? What are we missing? There is no foreign tax credit. Because there's no foreign tax. Right? So, when we book this DTA here, when we book this foreign DTA, it means in the future, no US FTC. In the future, when we use that DTA, it will rob us of a foreign tax credit we would otherwise expect. Right? So we need to book that as a DTL. Right? This becomes synonymous with a DTL in the US. Because if we didn't have that foreign deferred asset, we would get a foreign tax credit, pay an incremental 5, it'd be no problem, but we're missing it. The foreign DTA is causing us a US tax problem, and that's a DTL. And that will be true of every foreign DTA or DTL. So let me use a more basic example. So let's say I get a UK company, and it has a, for local purposes, let's say that its book basis in fixed assets is 100, its tax basis is 90, there's a difference of 10, tax rate's 20%, so I have a 2 DTL. So if they went out and just sold their truck for book value of 100, they would pay 2 of tax, right? What happens if they pay 2 of tax in the UK? We get a foreign tax credit, right? If this goes to payable, then that means, boom, goes to foreign tax credit. So that means this DTA means we need a DTA in the US, right? If they pay tax locally, we save tax in the US. If they save tax locally, we pay tax in the US. You might have seen on this note right here, it's similar to state taxes. You guys are probably like, oh, I hated that part of this slide. I know, I did too. But that's what it is. It's 2 jurisdictions where you're taxed in both jurisdictions, just like Fed and state. With a branch structure, it's Fed and foreign. It's not Fed and state. Same thing. Okay? So just how we had state deferreds and we had Fed effective states, in this example, we have foreign deferreds and Fed effective foreign. And it's not a deduction we get, it's a foreign tax credit, assuming we claim the credit. Okay. So that's branches. This slide talks about whether you double book NOLs, and you can read it for yourself. But the key is same as states. When you're branches, you're in 2 jurisdictions. When you're a corporation that's subject to state tax, you have a provision in the state, you have a provision in the federal, there's overlap, you have a Fed effective state. When you have a U.S. company that has a foreign branch, you're subject to tax in the foreign jurisdiction, but in the U.S. you get a credit, so you have that Fed effect of foreign. Okay, it's just in credit form and it's not all in the U.S., but otherwise it's the same. Okay, so I think that will do it for the recording.